Hi, this is James Chug at Westpac London office with the end of day report for Monday, July the 23rd. Look, things didn't get off to a good start, and indeed the Australian market yesterday suffered because of it, on the news that a Chinese policymaker suggested that the third quarter of this year might prove to have a slower growth rate than the second quarter just reported recently. And that hit equity markets here in Europe right at the open. But the issue was compounded in Europe by the news that another 5 regional governments in Spain are either seeking or going to seek bailout support from the national government. Now this comes on top of the news that one other region was doing that on Friday, and that the sovereign also is going to have to wear the liability for the bank recapitalisation bailout funds that 3 weeks ago EU leaders said would go directly from the ESM or the EFSF to the banks, but it was finally confirmed on Friday, as I reported last week, that the bailout funds would go to the sovereign first. They would hold the liability for it and then recapitalise the banks. So today we've got even more pressure on the books of the Spanish sovereign, and in one stage the Spanish stock market was down 5%. Similar losses on the Italian market too. Both those markets saw the officials put in place short selling bans, and it meant that the losses were pared back somewhat, and I'll run through the numbers in a minute. But it really looks like markets are twitching with anxiety, nervousness, stress, when they think about European leadership, the courage of policymakers. Well, the framework of the euro itself is almost being called into question every day. So the other issue today was that in Greece, the Greek Prime Minister Samaras, he described the situation in Greece as similar to the Great Depression in the US in the 1930s. I mean, he was talking to Bill Clinton at the time, to put that in context. Well, Greece wants an extra 2 years to meet its budget deficit reduction targets. To do that, it's going to need probably something like 40 billion to 60 billion euros more bailout on top of the 240 billion that have already been committed. There are reports today that the IMF was not going to pay its next tranche of bailout commitment to the Greek government. If that were true, it would mean that Greece would basically be insolvent by August and would default as soon as September. Now the IMF has subsequently said they've issued a denial of sorts, saying that they were working with Greek authorities to bring the budget program back on track. And it is true that the troika of ECB, IMF and EU officials do arrive in Athens on the 24th, which is Tuesday, tomorrow, to go over the books, etc. So they are working with the Greek authorities, but there's just a lot of nervousness about the whole situation, and it's in the same week that the American GDP figures come out that a year ago this week triggered or contributed to triggering the big sell-off in stock markets that took place in August last year. So it's interesting that European concerns are really hotting up as well, just a few days before markets might go quiet during the Olympic period. There wasn't much on the data front today. We had European consumer confidence come out. It fell from minus 19.8 to minus 21.6, so 1.8 point fall, but that's to the lowest level since the recession back in 2008, 2009. I'm getting sick of saying it. Almost every data piece that comes out of Europe these days is running at the levels it was running in the last recession. So we had some earnings reports. Who was it? Macca's in the US didn't meet analyst expectations on sales. Their share price is marked down. Apple's either after the close or tomorrow, always one to watch for. Here's some numbers. FTSE in London down 2.1%. The French market down 2.9%. The Germans down 3.2%. The Spanish market down 1.1%, but they were down 5%. And the Italian market down 2.76% at the close, and the Dow's down about 1.2% at the moment. The broader S&P down 1.4%, with the Nasdaq down 1.8%, and that's at the US lunchtime. In bond markets, Spanish bond yields hit 7.5% today. They've pulled back a little bit since then. More evidence that investors increasingly doubt the ability of the Spanish sovereign to keep financing itself for too much longer. There's the suspicion that things need to get really bad in Europe before the European Central Bank will step in and fire up its securities markets program, where it purchases the bonds of countries like Spain and Italy to hold yields down. So maybe that's going to happen sooner rather than later now. Let's wait and see. Our view is they might even do it without sterilising those purchases. That is, use their balance sheet to support those bond markets, to buy those bonds. That would give them almost unlimited purchasing power, and just like the Bank of England and the Fed has. But for the ECB, up until now, it's been a no-no for legal reasons and because of moral hazard issues and so on. Okay, in commodity markets, oil down 3.2% at $88.89 a barrel. Copper prices are off 2.4%. Gold is down 1/3% at $1,577 an ounce. During the London session, the Aussie dollar has lost about 0.5%. It's at 1.026 against the US dollar. We've got Ben Stevens speaking, issues in the economy. That's his topic, I think, and that's Tuesday Australian time, and that's it from me for today. Okay, back tomorrow.